I got an email, thought it would make a good video. Person says, Paul, got a question about a mother-in-law. She's 82 years old, and she has all of her money, about $1 million in CDs in different banks. She's never trusted the stock market and doesn't want to put any money in stocks. About $200,000 is coming due, and she can only get 1% at the bank that she works with. Now, the broker that works at the bank had recommended something. He said that she could put her money in government bonds where she could get 4 to 5%. The government bonds are not insured by the FDIC, but by the SBIC. She doesn't want to lose any money. What do you think? Would really appreciate your help. Well, the issue right here is this. Number one, we don't really need to have insurance on government bonds if they are indeed regular government bonds, because the government can print money and they can tax. The money is backed by the government, so we don't have to worry about that necessarily. But we do have to worry about interest rate risk. And that is when interest rates go up, bond prices go down. Now, that can be a real problem. There's a Merrill Lynch study that I looked at, and I verified the numbers to make sure that they were correct. But if you have an interest rate on a 30-year bond of 7% and it goes to 9%, for example, just a 2% difference in the interest rate, you will have an over 20% drop in the bond's price just based on that move in the interest rates. Now, you also can have, if they're not regular government bonds, you can have default risk, and you can have, currency risks. The currency starts to devalue against other currencies around the world. There are all kinds of other risks that I go into in other videos, but just realize that that is a big risk with this particular transaction. Now, that's with 30-year government bonds. We're talking about bonds that won't mature until she reaches age 112. That's an awful long time. Now, if they're not regular government bonds and there's something else and there's a higher interest rate involved, always remember this. If there's a higher interest rate being offered, there's a reason for that. And the reason is that they must offer that higher interest rate to attract your money. They have to. So now we've got other risks involved that we have to worry about. Now, I know that a lot of older people worry about the stock market. They're concerned about stocks and investing in the stock market. Maybe they heard stories or lived through the Great Depression, and they heard about people losing all of their money. Now, typically there are a couple scenarios when people lose all their money, or when they lost all of their money. Either they invested in too few issues, they didn't diversify their portfolios, or they borrowed money to invest. Now, I do videos on that as well if you want to look at some of the archives. But the point is this. Everything is based on the stock market. Everything. If the stock market goes away, if a company goes away, if companies in general go away and profits go away, always remember what I say about this. If profits go away, then taxes go away. If taxes go away, then FDIC and government guarantees go away. So everything is based on our capital system. So the only way we can really protect ourselves as investors is to make sure that we're diversified across all kinds of different financial instruments, because there are no guarantees in life, and especially when it comes to investing. We'll catch you next time.